fund to fund, syndicate. What does any of this mean? So let's first kind of just break this down real quick. What the different levels of putting together a real estate offering are.
All right. So
let's start at like the most
syndication?
basic. No, not even a syndication. Like, what if like you, me, and the boys want to just put together a partnership real quick and buy some real estate? Us four.
So that at the most simple level is the four of us come together. We create an entity, an LLC. There's four partners, 25% each. We each put $100,000 into it. We go out and we buy a deal. For every dollar that comes in, each one of us captures 25 cents on that dollar. Then that's
the most basic.
That's the most simplistic, basic, way you could do it.
And we're not selling.
Actually, arguably the most simplistic is somebody does it by themselves, but more likely it's a group.
We're not selling security. You don't have to worry about a lot of the regulation that we.
Nope, it's four quote unquote GPs, general partners. Nobody's passive. Everybody's equal share. Super straight up and simple. Next layer above that is a syndication. Syndication is where you have a central manager who is bringing the deal to a group of people and saying, I need to raise, let's just say $1 million. And he brings in 10 people at $100,000 a piece. They each own 10% of the deal. And you go out and you do the deal. And you have no say in the business. You don't make operational decisions. You default to the general person who brought you the deal. So they kind of, have one guy who's making all the day-to-day operational decisions. Everyone else is just getting the cash flow from the income that comes in.
So you have a split between a general partner or the general partnership of people, and then you have the limited partners, the investors that came in, right?
Yeah, but I'm assuming in this scenario, the general partner also put in $100,000. So $1 million deal, the general partner put in $100,000 and then brought 9 more people for $100,000, $1 million total. And then the general partner not only has 10% of the deal, but probably gets some sort of a kicker on top of it for doing the lifting.
And he's managing it. He's the controller.
Yeah. And the investors, the 9 people, are really hands off. They're just kind of sitting on the sidelines watching the deal kind of happen. And maybe they vote on some decisions. More than likely, if it's a general partner who's pretty seasoned, they'll have the acumen to not have too much shareholder input on decisions because it just bogs down the system in many, many cases. So that's your syndication, which is probably what we see the most out there, right? Single property, one deal at a time, keeps going back to the same 9 people, or as the deals get bigger, expands beyond that circle.
Yeah, in our size of real estate, that's what we see a lot. The $5 to $100 million deals. It's a lot of syndications. Maybe 100 is maybe north of maybe 5 to 60 million. You see a lot of.
I've seen some of the syndications in the $1 million ranges too.
Okay.
Yeah, so they can get small also, and then you have a fund, and a fund is really a group of syndications in one deal. So think parent company, and then the parent company is what goes out and buys all the individual assets, and so the investors own the entity at the top of the house. The entity at the top of the house owns the sub-entities, which are on title on the properties themselves. And so in that scenario, you're talking about probably hundreds of investors at this point now because it's a lot more deals, it's a lot more capital. Now you're in the 50, 60, 100 plus $1 million range. And so that's kind of like the next level up. Now in that scenario, investors are truly removed from day-to-day operations, from decision-making. There's a handful of kind of shareholder rights that they have where they have to vote if there's an amendment to how the parent entity is operating. They'll have to vote on stuff like that or at least have disclosures made to them. It's way more complex. There's pros and cons, I would say, to syndication versus a fund. But that's, kind of like that next level up where there are funds that have hundreds or thousands of properties in them. And so these guys are basically spinning up a fund, an investment vehicle that's going to, let's say, put $10 million into it. And the investors that come into the fund or into this parent company are going to invest a little bit in Commune, a little bit in BlackRock, a little bit in here, a little bit in there. And so they're aggregating basically private equity investments on behalf of their investors that own the parent company. And that person, for vetting where the dollars go, for overseeing what's happening with them, for reporting back to the investors, is getting paid something, whether it's a fee, whether it's a split of the profits. They're making their money some way, shape, or form. It really depends on how they're doing it. So that's kind of who these people are that have started to pop in. There are these fund-to-fund guys where they have a fund with all their investors, and they take a portion of the money in that fund and they invest in, let's say, one of our real estate funds where there's, 10, 20 properties in them. So that's kind of the background of how this works.
And there's nothing wrong with doing a fund to fund.
There's nothing wrong with doing
the
a fund to
problem
fund.
is that you're seeing, and that what we're talking about is, it seems like some of the fund managers or the person representing the fund has no clue what they're doing. The questions they're asking and the expectation is so wildly off that you're saying, oh man, for whoever the investors are in this fund with them, I would be terrified if I were them. That's what you're saying.
I'm saying investor beware.
Investor beware.
Right? You have to, if you're putting dollars in, and 35 million, assuming that.
There's no way, bro.
I agree. But, let's take it at face value, right? If that was the case for this, that's a lot of money to be put into somebody's hands. And based on the questions I was asking and the answers I was getting, I wouldn't have put $1 with this person, right? And so I look at that and I say, if you're the investor who's investing, are you asking the right questions, or are you just taking the relationship you have with this person for what it is and putting money with them? And then it's concerning because you start to see this kind of pattern developing where, the fund manager can make some bad decisions, invest in some companies that they didn't properly vet, they didn't thoroughly understand, they don't have shareholder controls over, and all of a sudden he's putting his friends and family members' money in a deal that he or she doesn't understand. And if that deal goes south, this person in the middle is saying, wasn't my money. It is what it is. I can't do anything about it. And all these investors who put all their belief and faith in this fund manager are now, SOL because their money's gone and they can only learn the lesson after the fact. And it just caused me to think about, we've had too many scenarios in our past where investors have been taken, and there's a level of due diligence and vetting you as an investor have to do before you're writing a check.